Welcome to the Master Your Money podcast, where we take a dive into the complex relationships humans have with money. Plus, we'll explore the best and worst money moves we've made along our financial journey. All opinions expressed by myself, Ryan Greiser, Fran Walsh, and our guests are solely their own opinions and do not reflect the opinions of Opulus. This podcast is for informational purposes only and should not be relied upon for investment, tax, or legal decisions. Clients of Opulus may maintain positions in the securities discussed in this podcast. Let's get into it.
All right, so let's dive right into this week's episode of the Master Your Money podcast. Just so everyone knows how we're going to be doing these moving forward, if you have not already subscribed to our newsletter, it's a great resource. What we've done is we've fully revamped them. What we're doing is we're taking turns kind of writing, our thoughts on certain investment topics each week. And then what we're going to do here with the podcast is, every other week when we don't have a guest on, what we're going to do is dive into, some further details on those topics and, really try to harp more on some tips and things that you should be doing in your financial.
Yeah, it'll be great to dive into those topics and just talk about best practices and how to master your money.
So this week, what we talked about was, for anyone that is a Ted Lasso fan, this week's theme was called Be a Goldfish. And the whole idea behind that was, Ted has a famous saying to the players, tells them to be a goldfish, meaning to have a short memory, forget about it, move on. And, in all facets of life, this is great advice, right? It's always good to have a quick memory, except when we're talking about investing, right? The common theme of investing, we want to use history as our guide. We want to basically look at all the things that have happened in the past, all the successes, all the failures, the good, the bad, the ugly. And what we want to do is use those to our advantage to make smart decisions moving forward. So this week, some of the things we talked about all revolved around how we can use history as our guide. And there's basically three main topics we're going to dive into that coincide with that. And that is avoiding recency bias, using historical performance and historical, analysis on our side. And lastly, just having a long-term mind.
Yeah, and recency bias is one of the biggest ones that I saw this year in our client conversations or conversations with friends as we were talking about money, investing, what have you. And recency bias is real simple. It's making emotional decisions based upon the recent events that have occurred in your life or in your portfolio. Naturally, as you can imagine, is not very good to make long-term decisions based on recent events that have occurred, right? Like in 2022, for example, the stock market's the easiest way to think about this is the S&P 500 was down about 19% in 2022. The NASDAQ, which is mostly technology stocks, was down about 33% in 2022. Yep. And heading into the year, every analyst or anyone who does any projections on what is the market going to do from January 1st to December 31st pretty much said, well, I'm not sure, probably positive, but mostly it's going to be really, really rocky, right? It's going to be ups, it's going to be downs. Who knows where we're going to end up? And most people said single digit returns, maybe high single digits would be a really good year. Yep. If that were the case, right, for the markets. So we were actually in a Market Watch article talking about this earlier in the year, and the journalist asked, hey, CDs, U.S. Treasuries, savings accounts are at 3, 4, 4.5, and here we are in late June. They're up around like 5.25% on some U.S. Treasuries. Yep. CDs are up around there too on the institutional side. They said, hey, is cash the right thing to do? If economists are expecting a choppy road, single-digit returns, should you just forget investing and put your money into 4%, 5% and call it a day and wait for the dust to settle? And listen, there are a lot of advisors or people out there like, yeah, you know what? Like, forget bonds, forget trying to time things, like put it in there. Our views were a little bit different on that. And I think most really good advisors had probably the same views that we did, is that, listen, if you have short-term money that you need in the next 3 months, 6 months, 1 year, 18 months. Me and my wife are planning to do a home renovation in the near future. Like, that is money that we're not willing to risk because it has a shorter time horizon. Our mindset was, and still is, like, hey, yeah, take 4%, take 5%, mitigate the risk for the short-term time horizon all day long, right? But for long-term money, goals that you had for more than 18 months, where some people were saying, yeah, just get to 4 or 5%. We're like, well, like, we're not sure what the market's going to do in the next year, but if we're following good, sound rules, that's probably going to be a bad decision, because if you park your money in 4 to 5% for a long-term strategy and the market takes off, you could potentially be stuck in that and you could miss the upside. And unfortunately, some people did that, right? They used the recent events of a bad market in 2022, higher than normal interest rates than they've ever seen, poor economic predictions on how the markets were going to do, said, forget the volatility. I just got destroyed in 2022. I'm going to lock in my 4 to 5% and turn around what's happened, right? Year to date, as of, we're in June here, end of June, and who knows what's going to happen the rest of the year. S&P is up 14.3% as of today, year to date. Technology sector, or the NASDAQ, is up about 37% positive, right? Like most economists were expecting a single digit type of return year. S&P blown through it. Technology, the NASDAQ has absolutely destroyed it. So the comments that we made in Market Watch early in the year have held out to be really, really true and sound, is don't make decisions based on recent events. Have rules. If you need the money short term and you need security, get something that's guaranteed at the highest rate possible. But if you need long-term money, long-term growth, that's not the best route to take. So when we really look at the recency bias and making decisions on recent events, you have to have rules and you have to follow them, even if we just got destroyed in the previous year. And those rules that we've set out and used on a day-to-day basis have proven to be really effective here so far this year. Now, time will tell how the year ends up, but that's how the cards are unfolding so far.
Yeah, absolutely. And I guess the only thing I would really add to that is, other great examples we had was like how many people called us towards the end of last year when things weren't looking good and we're like, I don't know about tech. Tech just got crushed this year. I feel like we should get out of it. And, obviously we're like, hey, we have a plan, stick to it.
Yeah.
Now all of a sudden, everyone's calling us, NVIDIA's up a bajillion%. They're like, hey, do we have NVIDIA in our portfolio? It's like, yes.
Had them before, still had them.
Yes,
right?
we don't let the conditions change our overall mindset. We are long-term investors. Don't let these recent events and these flashy headlines that are designed to get you to click and freak out alter our decision making. We need to hold strong. We set a plan for a reason. If we need to make slight adjustments here and there, we will. If your conditions change, you can absolutely change things. If you obviously feel like your risk tolerance isn't exactly what it might have been before, changes can be made, but we're not making wholesale 180s every time CNBC drops a new one.
And I think something that's helped me out personally as time gone on, I forget if I saw this in a blog or a tweet or something, but instead of thinking of the S&P 100, think of Apple or Google or Amazon. And then taking it one step further is looking at my biggest investments. If we look at the S&P 500, the whole is it is Apple, Amazon, Google's of the world for the most part, some other ones that are in there. But is Apple going to continue to manufacture and sell computers and their products? Right? Is Google going to continue to sell ads on there? People going to continue to search on there so they can generate revenue? Is Amazon going to continue to ship packages all over the world and people sell more? Yes. So as long as those things are still happening, the valuations of those companies are going to change over time. They're going to impact the portfolio. But just because some recent event happens doesn't mean that these companies are going to fall apart. Right. And eventually they're going to pop back for that. Now that could change, but that's something that has helped me overcome some, recency biased or bad news about recent events, is thinking long term, how are investments going to do and what do these companies produce, and are people going to continue to buy them in a profitable way?
Yeah. When you start getting a lot of green text messages, maybe that'll be that, hey, maybe we should pull back a little bit.
Not on my watch.
Yeah, I was saying, but until then,
as we're on our Apple computers.
I was saying, I have everyone I know still has an Apple phone, so that's where we're at there. All right, so let's dive into the next part here.
Yeah.
Using historical performance as a guide. Essentially all this is analyzing market patterns, trends, and using that to see, hey, where are there potential risks? Where are there potential opportunities? And, a great, someone who did a great analysis on this is this guy's name is Ben Carlson. He has a blog called A Wealth of Common Sense. And essentially what he did was he wrote out an article. This is back towards the end of last year, late October, I believe. Basically said this is the 9th time since 1950 that the S&P 500 is down 25% or worse. Past performance is obviously no guarantee. It could certainly get worse before it gets better. But historical returns from down 25% are pretty good on 1 year, 3 year, 5 years, and 10 years out. And obviously he's got a chart and a full article outlining this. But essentially, what does the chart do? It ends up showing, hey, every time there's a 25% or more decline, 1 year out, we're green in 8 of 9 scenarios. And then 3 years, 5 years, 10 years out, we are in the green in every single one of those scenarios. So what does that tell us? Hey, even when things are choppy in the short term, if we keep that long-term mindset, more often than not, obviously there are no guarantees, but we are going to be okay as long as we can ride it out. So, we go back, obviously there's no guarantee. Past performance is no guarantee of future returns, but history doesn't repeat itself. It often rhymes. So when we can use these scenarios and say, okay, what has happened in the past? If we have another 25% dip this year, that may open our eyes to say, okay, this might be a good buying opportunity if there's funds on the sidelines that we don't need over the next 1 year, 3 year, 5 year, 10-year period.
Yeah. And it's never identical, but listen, I'm not willing to bet against a once-in-a-lifetime event happening that is going to wipe out the markets, are going to be non-existent, and the biggest companies in the world are going to.
Yep.
And if that does happen, who really cares anyway?
Yeah.
Right. Like
if everyone's going bankrupt, who cares? Yeah.
Right. Like that's just not a bet that I'm willing to make. So if you need to be in the game to win it and to build long-term wealth, unless you're just doing it in your own independent way, which you are, great, good for you. But if you just want to be hands-off and invest in the market, like this is the easiest way to build long-term wealth because the odds are just stacked in your favor.
Yep, absolutely. And then, obviously just going hand in hand with that, our mindset preaching is to always have a long-term. We are not day traders. We're not in here to make a quick buck. So if you are someone who is that, maybe you have different thoughts on these things. But for us, we're making long-term plays. We're making small adjustments when needed. But, overall, when there's negative times, when there's all these, headlines, when everyone's all their heads down in the dumps because the market's down 20%, there's that old phrase, when in doubt, zoom out, right? How many different times was there a dip in the market over the last, 10 years? There's been 7 or 8 of those different scenarios over the last 10 years. But when you zoom out, you can't even see those because the market's continued to climb over time and the market's been resilient. Companies continue to innovate. Economy continues to grow, all that good stuff. So just focus on the long term. Try not to let the short term affect you.
Yeah, when you zoom out, it's easy to point to these dips in the market. One, you just got to stick in. Right. Yep. You got to stick in, you got to wait them out. And then 2, it's easy to look at it and say, man, I would have invested so much money then. But when you're in it, there's a lot of uncertainty. There's a lot of doubt. But if you do have the cojones to do it, the dips are a great opportunity to buy in. And at a minimum, what I love to do personally is I know what my long-term goals are. I know how much I need to save. Highs, lows, regardless of what's going on every week, I'm just dripping in and investing and investing and investing. So I do not have to time those drops perfectly. And I know I'm going to be buying in on good times and bad.
Yep, absolutely. All right. So with that, lastly, our actionable tip of the week. That's what we're going to be dropping each week. So, for this week, it's really simple. Stop opening up your apps. Stop panicking every time you get a headline, you get a hot pick, or you see there's a GameStop or whatever any of those companies were that were flashing 1,000% in a week. Figure out what your long-term plan is, how that aligns with what your personal goals are, and stick to it. Don't let the knee-jerk reactions and those headlines throw you off and totally upend your plan every time you feel like this is a once-in-a-lifetime opportunity. Let the hard work that you're doing continue to have that small steps, keep building momentum, and keep getting closer to obtaining financial independence for yourself and your family. With that, hope you guys enjoy. We'll see you next